Hi everyone. Welcome to come to our last webinar this semester. We are very happy to have Olivier to talk about banking on uninsured deposit. As a reminder, we will have a 15-minute Q&A afterwards. Okay, so the floor is yours.
Hi, so thanks a lot for having me. This is joint work with Itama, Alexia, and Philip. So this is called Banking on Uninsured Deposits, and the motivation is simple. It's what happened earlier this year. So what happened? The regional bank turmoil or crisis. Well, since early 22, the Fed has raised short-term rates very aggressively to fight inflation by more than 5%. If you look at long-term rates, which are the ones relevant for asset classes, they are by around 2.5%. And so if you look at banks' balance sheets starting from at the beginning of this hike, they had basically $17 trillion of long-term loans and securities. And if you do a back of the envelope calculation for their average duration, you get something like 4 years, which leads to an implied loss of around 2.5% times 4 times the actual dollar amount, which is around 1.7 trillion. And so that's very large compared to the $2 trillion of equity they started with. So Gregor has worked on a paper with even more precise estimates, but it's kind of in this range. And so when some banks started failing, seeing like very large withdrawals, there was kind of the sense that, well, given these numbers, you're going to have a big problem. There's just a lot of mismatch, and in fact, even kind of famous commentators like Larry Summers said, SVB, which was the outlier, the extreme case, committed one of the most elementary errors in banking, borrowing short and investing long. And so naturally, when rates go up, assets lose value, and you have a problem. Now, in a sense, so it's hard to interpret what has happened since, because you had a very strong policy reaction. But in a sense, given these numbers, what's been surprising is why many other banks didn't fail, and why all this happened so late, given that hikes started much before March 2023. So here I'm showing you on a graph, in black, you have the path of the Fed funds rate, starting 21 until now. And you see that, already in March 22, rates increased, but for a long time. And, similarly, if I showed you long-term rates, you would see them increasing even before, because part of it is anticipated. And for a very long time, banks didn't seem to respond to these rate hikes more than the market itself. So in red, I'm showing you the bank stock index. So these all banks, but if you plot, regional banks, it's kind of similar in this period. And you see that compared to the market in blue, the S&P 500, you didn't see that much action until SVB failed in March 2023. And then you had a big drop, and it can, so there is a significant loss in value, some rebound, but clearly there's been a gap that didn't close up even now. Okay, and so there are two ways to view this thing, which is there were obviously big losses and panics, but also a lot of stability. Again, it's hard to interpret because of the policy response. But one view is that, and that has come to the attention a lot since these events, is that banks have a natural hedge to interest rates. And so if you think of marking to market the assets, you need to think about what's happening on the liability side as well. And so here I'm showing you over the same period, the rates that banks pay on their main liabilities, which are deposits. And this is aggregated, across all banks in the US and weighted. And you see that, for different categories of deposits, so checking in green, savings in red, and time deposits in blue, what's tracking is that as rates increased, so in black you have again the Fed funds rate, as rates increase, the adjustment to the in terms of deposit rates was very small and slow. And so this is something that's happening all the time. Every time you have interest rate increasing, so there's a big gap between deposit rates and market rates. And not only there's a gap, but the gap depends on rates. So this means that the spread that banks can earn between market rates and what they pay on deposit rates is increasing with the level of rates. And so if you think of the spread, that means that when banks when rates go up, banks become very profitable in terms of their deposit production business. Banks do many things, but one thing they do is something allows them to pay these below market rates, and the spread that they can earn is increasing with interest rates. So that would be this distance between the black curve and some weighted average of the other ones. Of course, as interest rates go up, you also have some composition effects. Some checking deposits become savings, and so you have some increase in the rate that banks pay on average on their deposits, but that's pretty stable. And so overall, you have a strong increase in the spread. So to put some numbers again, so that effect of interest rates on higher profits that banks can earn from paying below market rates on deposits can be quantified again with some back of the envelope calculation. If you think of banks starting from $17 trillion of bank deposits, so kind of similar to these assets, thinking of the beta, which is how much of the market rate is passed through to deposit, taking 0.4, which is actually slightly higher than the recent values we've seen. That means that banks are earning 0.6, 1 minus 0.4 from the increase in rates. And so for a 5.5% increase in rates, that means like a deposit spread that goes up by 3.3%. And so that means if you translate into income, they are earning $600 billion more in income per year. And so the gains on that deposit franchise, effectively, banks have this intangible asset, which is the deposit franchise asset, which is the present value of these profits they're going to make from paying below market rates on deposits. The gain on that is enough to offset these asset losses. So everything is very large. The losses are large, but the profits that you can make are also very large. And so basically, when rates are really low, deposits are not profitable, everything is kind of compressed towards zero. And so if you look at going from 2021 to 23, deposits went from unprofitable to highly profitable. And that is part of why bank stocks kind of typically don't respond that much to increase in rates, including in the cycle. So now what's the issue with that? The issue is that you need to be able to earn these higher spreads. And so that's only going to happen if these deposits stay with you. And so there are really two reasons why the deposits could leave. And so meaning taking away with them the present value of these spreads that you're expecting to earn to offset the losses on the asset side. And so this paper, is really about, is the deposit franchise a good hedge? Well, it depends, it's going to depend on whether deposits remain with the bank. And the hedge can be undermined by two kinds of deposit outflows. Conceptually, we think they're conceptually distinct. One is, standard, what we call rate-driven outflows, which would be, just outflows of deposits toward money market funds. So some depositors look for, higher yield opportunities. And that's something that you see all the time. That's what my co-authors have called the deposit channel of monetary policy. In fact, you could view this as one of the main channels, standard channels of monetary policy transmission to banks and to bank lending eventually. So I'm not going to focus too much on that today. What's conceptually newer and more interesting is that, if you have a lot of uninsured deposits, like some of these banks had, you can get these self-fulfilling runs on this intangible asset, which is the uninsured deposit franchise. Okay, so the first kind of outflows, you see them for both insured and uninsured. And then they're not really a financial stability issue. It's something that's kind of smooth. Bank can try to estimate these flow elasticities and manage it. So it will have implications for the kind of assets they should hold. Given these outflows, banks should indeed, reduce their asset duration to remain hedged. But the second kind is much more, hard to manage. The reason is that effectively, the duration of deposits is contingent on the equilibrium that's going to happen. And you may have a situation with multiple equilibria, where in one equilibrium, deposits can be treated as effectively as a long duration liability. And so they are a good hedge. The deposit franchise is a good hedge against interest rate risk from the asset side. Whereas in the bad equilibrium, deposits suddenly become short duration, and you lose this hedge, you lose this franchise. And moreover, whether the duration of deposits is long or short is going to depend endogenously on the assets that the banks or holding. Okay, so if banks make more losses, it's more likely that deposits become short duration. So just to show you a bit what the kind of outflows I'm talking about. So you see in red here, again, over the same period, deposits increase a lot during COVID, and you reach, very high, 17 trillion, which at the peak, right before the Fed started hiking. And as soon as the Fed started increasing rates, you saw first, there's more like stable, slow withdrawal, which we call rate-driven outflows. And then with the SVB failure, some kind of kink and stronger outflows. But overall, this part stabilized. And so if you look overall, you still have a lot of deposits in the system, and a lot of deposits are still, pretty low beta, meaning that banks are earning a lot of money from them. Again, the Fed and regulators, took many actions to stabilize the system. But overall, if you look at the size of the hike, the extent of the outflows is not that crazy compared to historical standards. In fact, it's kind of you could still expect more outflows if you try to match elasticities of outflows to rates that you saw in the past. Okay, so the main results are quite simple. You have this intangible asset, the uninsured deposit franchise, which is runnable. And so the key thing is why it's runnable. So in a way, it's very similar to Diamond Deep Vig, self-fulfilling runs. Because you're going to have these two equilibria, and it depends on the confidence in the bank. But in a way, it's also very different because you can see these runs happening even if on the asset side, the bank is fully liquid. So it's not an issue of having either, like in the original Diamond Deep Vig model, some technological illiquidity. So you have these long-term assets and you lose value if you liquidate them earlier. Or, more generally, if you have fire sales and so on, all these runs could happen even if the bank on the asset side is fully liquid, agency MBS, treasuries, and so no discount just coming from the fact that you have to sell. Okay.
So, Olivier, if I can jump in. So the same mechanism is in my AR 2017 paper. So I'm just kind of trying to see what here is sort of the new part, what is in the literature already?
Right. So here, because it's a bit short, so I'm not having a big literature review, but absolutely, some of this force, was present in earlier papers like Gregor's. And so it's true that, in general, it's coming from the fact that I think in your paper, you have to pay higher rates on uninsured deposits if you're closer to bankruptcy. And in fact, I'm going to mention something in the model that kind of resembles this and could get closer.
You have rates and quantity, right? I mean, you have both. When rates go up, you lose quantity. When a bank is close to default, rates go, you have to pay higher rates and quantities go down.
Right. And in a way, from the model's perspective,
it's the same thing, exactly.
We would agree that whether you start paying higher rates or they go away, you're losing the franchise value in both cases, and that's kind of undermining and amplifying. So I agree with that. Maybe in a way, the most important part is the second part I'm coming up to talk about, which is so you always have some kind of risk like this, but unlike in Diamond Deep Vig again, there's a very natural dependence on interest rates, which is because this deposit franchise value, so the value of this intangible is rising with rates, which is the key point in my co-author's previous paper, banking on deposits, but where they didn't talk about the implications for runs and outflows. But you have this asset that is runnable, that is intangible, and whose value fluctuates a lot with rates. So it has a negative duration. Its value goes up when interest rates go up. Then it means that liquidity risk, run risk, increases with rates. So you have this very natural dependence in interest rate. And I think that's the really striking thing, which is you wouldn't see that, you wouldn't expect that to arise naturally in the Diamond Deep Vig model, for instance. And now going ex ante, what can the banks do? As I said, whether the equilibrium is going to be good or bad also depends on what banks do on the asset side. And so that's also a newer, I think, conceptual point, which is banks face this risk management dilemma. On the one hand, basically you have two equilibria, and in each equilibrium, the duration of liabilities, is different. And so what you should do on assets depend on which equilibrium is going to be played. And so on the one hand, if you assume, you're not going to have a run, you really need long-term assets to hedge banks' exposure to interest rates through the deposit franchise value. Basically, because when rates fall, banks are going to lose a lot of profits from the compression in deposit spreads, then they need to hold long-term assets to offset that, to keep paying for their operating costs, for instance. And you need these long-term assets to gain in value to offset the loss in value from the franchise. But then you're more exposed to runs when interest rates increase. And so, as rates rise, the relative value of an insured deposit franchise goes up, liquidity risk goes up. And if you want to deter that, what you have to do is do the opposite, which is you need very short duration assets to make the asset side insensitive to interest rates, so that you kind of prevent this run equilibrium from appearing. And so you're going to have a dilemma ex ante, which is the bank cannot perfectly hedge both risks simply because you have these two equilibria. And so what we propose is some solutions. Basically, what the model is calling for is you need some contingent duration. You need, high duration for the cases where interest rates are going to fall, and short durations for the case when interest rates are going to rise. And so you see that there's some kind of convexity that the banks need. And the way to implement that, I think the most natural way here you're going to see is through options on interest rates, which are going to trigger and change the duration of the asset side of the bank exactly when the bank needs a shorter duration, so that financial stability is not an issue.
And Olivier, sorry, just maybe you'll get to this later, but when you think about hedging in the good equilibrium, what's the welfare loss from volatility? Like in a bad equilibrium, sort of we all see it, but in the good equilibrium, do you need to hedge?
Here, we're not gonna, really microphone that. That's a very good point. So you need to hedge because you have these, operating costs that you need to fund. And the problem is, if interest rates fall by a lot, you're gonna run into some constraint that you have to pay for these expenses.
But then you're already in the kind of the bad equilibrium state anyway. So
so it's gonna be a bit asymmetric, which is the problem is, if you're in a low interest rate environment, the deposit franchise is very unprofitable.
Right.
And so it's not really the same kind of problem, because if they leave, it's not a big deal to you. It's more like, well, like in 2021, many big banks were like, oh, we have this regulation, on leverage. We don't really need that many deposits because they are not profitable anyway. And so it's not really a run in the sense that as they go away, it's not hurting your value because they're not profitable anyway. So it is an issue in the sense that your value is lower, you're closer to insolvency, maybe you're more exposed to other shocks like credit risk. So that would be an issue. Maybe you're going to have trouble funding this operating cost. You're going to get closer to like a zombie bank, which is very low capital and unprofitable. So all these reasons, in fact, it's what people focused a lot on before 2022, which is for a long time you had declining rates potentially hurting banks. So you had a huge literature on like reversal and these things. And all this is not modeled here. We just take as given that the bank doesn't want to see its equity fall too much when interest rates fall. And that's going to happen unless it has long-term assets to offset the loss in deposit spreads.
So do we know, Silicon Valley Bank aside, do we know that banks with more uninsured deposits have longer term assets? Like, before, go rewind right into good times, into the low interest rate times when there was kind of very little perceived run risk. Because, like in the data among the regional banks, it's kind of the other way around. I mean, Silicon Valley is very much the exception in this case, piling into these very long-term treasuries for whatever reason. But it at least in the regional banks that I've looked at, it seems like more uninsured deposits tend to go with lower duration.
Right. So the question is it low enough? So it could be that they need lower duration and they do part of it, but they don't go all the way enough to ensure stability. And I think in Gregor's paper, you can see that as kind of what you're saying, it's really the interaction of you need a lot of uninsured and big losses to have an issue. But maybe this interaction was really strong for SVB and not as strong for others. But if you interpret the model, it would say that, well, if you have really like 90% uninsured, your duration should be lower than 1 year or something. So really even shorter than what we see. So it's not like Silicon Valley Bank is extreme because they do like they go in the wrong direction. But this dilemma is not just about going in the wrong direction. it's like, even if you try to go in the right direction, it's unclear how far do you want to go. Does it make sense? So I'll come back to some, maybe in the model we can talk about these objects. Yeah,
Olivier, just a quick question. So a bank that would not have had a deposit franchise and would have sustained the same losses on this long-term asset would have failed as well, right? So here you kind of saying that having this deposit franchise in the first place is a way to keep this bank afloat. But
the bad equilibrium is where the franchise disappears. And so if you didn't have it in the first place, you would only have the bad equilibrium. What the franchise is doing is creating the good equilibrium, and kind of explaining why you don't see this happening all the time, unless it's very extreme, because you have a lot of stabilizing forces. But the puzzle,
I'm talking about a bank. Let's forget about the bad equilibrium, no run, but does not has deposit franchise. All of this bank would have entered bankruptcy if they were funded, for example, with wholesale funding.
That's what I mean by the bad equilibrium, even though, it's not, I agree with you that in that case, it would not be, really self-fulfilling. It would just be the unique bad equilibrium. But I want to say, coming back to the dilemma, that, if you don't have a franchise, there's no reason to have, this big, this big duration mismatch, seemingly big duration mismatch, and these big losses.
You might have
a money market fund. If you're a money market fund, you have a beta of 1, you hold like short-term assets, and you don't have these big losses.
You might have a franchise value on the loan side.
Right. So this I'm going to ignore. It's a bit less obvious how that would vary with interest rates, although you could come up with different forces that make it go up or down with interest rates. But what's striking with deposits is that the money you're making is actually clearly going up with interest rates, and so you have this very natural negative duration. For loans, it could be that you have some negative duration, or it could be positive. It's not clear whether it should push you to increase your asset duration or not. Say on the securities. Yeah. Okay, thanks. So let me show the model. It's very simple. Try to have transparent valuation formulas for the franchise. So you have a bank starting with assets A. Their value is going to be contingent on interest rates and some deposit base D. Here I'm writing a slightly more general form, and then I'm going to specialize immediately. But just to understand the notation, I think it's useful to start here. In each period, you have some remaining deposits D, T minus 1. They pay some deposit rate RD, which is going to be below market rates. They require some operating costs. So running the franchise is not for free, and that's partly why banks want to have these long-term assets, because they have to pay for this cost. Here I'm assuming they're just scaled with the amount of deposits. Of course, in practice, you have a combination of fixed and variable costs and some adjustment costs. Maybe in the long run they scale, in the short run they don't. We talk more about this in the paper, but here, to give you the simple formulas, you just have these C per dollar of deposits. And then in each period, you have withdrawals. So here, it's not a model of steady state banking. I'm kind of taking a bank with some outstanding deposits and looking at the value of what it has now. Now, of course, banks also expand and acquire new deposits, but we're treating this as maybe a separate source of value. And you think maybe there's free entry in that activity. And so that part is not gonna, but once you've paid some kind of fixed cost of entry, you're left with the outstanding deposits. So here, the value I'm gonna consider.
Sorry, Olivier, just XT as an endogenous variable or exogenous?
Yeah, for now, I'm not saying what I'm gonna make endogenous is just X0. And then X1 and so on are going to be exogenous, just to kind of make it clean. So all the action, the endogenous action is going to be at date 0, and then X0 is going to be endogenous. Okay. Yeah, thanks. So the value is just the mark-to-market assets minus mark-to-market liabilities. That's what regulators or bankers call the EVE, economic value of equity. And so what's the assets we kind of, this is given, although we're going to let the bank choose it. And the liabilities, well, you have the present value of interest rate expense and costs. So for each remaining dollar of deposit DT minus 1, you pay RD plus C, and then you have these withdrawals. Okay, so this is more the general form. Now I'm specializing everything. So you start from some interest rates R. Think 1.5% for long-term rates. And then you're going to have a one-time shock to R prime, and then nothing moves ever again. Yeah, Gregor?
So why not do it more as a steady state? If you go and look back, if you sort of think of like, you know, all the x's move exactly, but you know, just one slide back.
Yeah.
When you have all the xt's, sorry, where do you have all the xt's move? Why don't you just have them move proportionally to x0, so it looks more like a steady state kind of equilibrium?
Oh, right. No, we have tried those two. In the end, you know, it was just for simplicity.
Okay.
Yeah.
Okay.
Yeah, initially, we also have a continuous time, what I'm showing you is really the cleanest version. It's closest to like a 2-3 period model. Like,
got it. Okay.
Yeah, thanks. So the deposit rate, but yeah, in practice, when you see outflows, especially the rate-driven outflows, you know, you can think of maybe there's some Calvo shock and some depositors are going to wake up, withdraw, and so there's an exponential or something. So that's something we have too, but you know, I'm not showing this here. Deposit rates adjust with the, you know, this beta. So this beta is a very important object, you know, beta between 0 and 1. Now, as I answered to Gregor, you know, at date 0, you have all the action, endogenous outflows. So really in the paper, we have two kinds, and we kind of treat them conceptually as separate, meaning one is rate-driven outflows, which is just standard outflows. There's some demand function, really, and some elasticities to rates. And so that would be what you have in gray here. Now I'm going to totally ignore this in the presentation and focus on runs. And for runs, you know, I can't write them as easily as this because it's going to depend on the solvency of the bank. So I'm going to come back to this. Okay, but that's where all the action is. And then following date 1, if you have some deposits left, you have some exogenous outflows at the constant rate delta. And really, it's more a quantitative issue. You know, you don't need this. It's just because we don't really want to overestimate the deposit franchise by assuming that, you know, each deposit you have is going to stay for 100 years with you and accept the below market rate. Eventually, they're going to leave for some reasons, you know, payments, withdrawals. And so that just makes the numbers for the deposit franchise more, you know, realistic. Okay, so given these assumptions, you get a very simple valuation formula for the franchise that highlights, you know, its key property, which is its negative duration. So what's the franchise? First, what I've defined so far is assets minus liabilities. But I keep talking about this franchise as an asset. We think conceptually, you know, it's you know, simpler and more transparent to write it like this. Instead of writing A minus L, I'm going to write A minus D, which is, you know, your value if you don't have a franchise, plus some extra DF, which is just the value of being able to pay below market rates on these deposits. Okay, so we put it on the left-hand side of the balance sheet. And that thing depends on R prime. So first, without outflows, what would be the value? Suppose they stay with you at date 0, and then you have the normal decay. You get a very simple Gordon growth formula. DF is just going to be, you start from D, which is your deposit base, and then the numerator is the income that you're making. So you're making 1 minus beta times R prime, that's the spread, but you have to pay the cost minus C, and then you discount it at R prime plus delta because there's some decay, okay? Now, the key thing is that if you take the dollar duration of this, so you differentiate this, you see that DF increases with rates, okay? So unlike a standard asset, A, which would fall with rates, this increases with rates. And from the formula, you see it's coming from two sources. One is the C over R plus delta square. That source of negative duration is just that you have the present value of the cost that you have to pay is going to be lower. Okay, you pay this cost, interest rates are higher, they come in the future. It's like a fixed, you know, like a perpetuity with fixed rate coupon on the liability side, and that has a lower value. So that's good. And the other term is 1 minus beta times delta. And that's the more intuitive thing, which is, you know, you're going to earn higher profits while the deposits are with you. Okay, so you see that, you know, if delta goes to 0, you don't have this because basically a floating rate bond that stays forever, you know, that has infinite maturity has no duration. But eventually they're going to leave, and that contributes to the duration. So both terms matter quantitatively. And so they both go in the same direction, which is DF prime is positive. So that's what I mean. You know, what I showed you on the graph was that you make more profits, but in terms of value, in terms of present value, it's also higher. Okay. Just to give you a sense of the numbers, I'm not gonna, you know, show more numbers. It's not a quantitative paper, but here, you know, if you think of beta around 0.3, you know, averaging across these deposit categories, cost 1.5%. So typically, you know, think between 1 and 2, are at 4%. So the new higher rate with a stock of deposit around 17 trillion. And delta, think of 0.1, so 10 years. If you value that, the franchise value at a higher rate is like 1.6 trillion, which kind of similar to the unrealized losses on assets. Okay, so now the losses are like the change in the asset value, and then the change in the franchise is kind of similar to this. Because basically you start from a situation which is close to zero franchise value, but when interest rates were low.
Well,
Okay.
Olivier, when I play with these kind of simple models, it seemed critical to sort of think about, you know, pass-through and how pass-through changes with rates. And I guess you sort of have a very, you know, once you put in a beta,
yeah,
you have a very strong structural assumption on kind of the demand for deposits. You want to talk about that a little bit more?
I see.
I mean, this is like it's a very cutting edge model in which beta, you know, in which you have a fixed pass-through over time. I mean,
okay, so you mean the beta is not moving? So
exactly.
So I agree.
Exactly.
So people have estimated, in fact, you know, and I also work on this, like the convexity, you know, of rates, so state-dependent beta. And I found in other papers, that, you know, beta is higher at higher rates. But so we do have an extension in the paper. We talk about that. Like if you look at recently, you know, so you have some variation, but it's not like it goes to 1 when we go to rates.
But if you take the derivative, for example, if you like have your derivative formula, and that's especially an important one, right? Then you sort of, I mean, it's sort of like the local elasticity of the residual demand of demand for deposits.
Absolutely.
And that's sort of.
So this is without outflows and with the constant beta, I agree. The DF prime, if you have the outflows, and you know they do play a strong role. These are the rate-driven outflows, and we kind of calibrate it to match the QJ estimates, you know, from the deposit channel paper. So then you would subtract some W prime, which is, you know, the quantities responding. And then if the beta adjusts, you also subtract some beta prime. So we have the more general formula in the paper. It's kind of ugly because now you have these 3 terms. I agree with you. And it can matter. What really matters is more the W prime, which is even holding beta fixed.
Of course.
Many of them leaving. And so that's, you know, kind of exactly mimicking but that's
in some way the choice of the bank, right? I mean,
exactly.
like the bank can in principle decide whether it wants to do quantity or price. I mean, it's very easy for the bank to keep a lot of deposits if it wants to.
Yeah. So we also described this where these objects are all related, endogenous and optimized. Right. So when I talk about, you know, here again, I'm not showing you these formulas, but when the bank is allowing, you know, outflows and beta to vary, it's all, you know, based on some optimization problem, where the banks, you should view the banks as trying to, you know, maximize its profits on deposits, and then it reaches some structure for the beta, for the pricing, and for the you know, resulting flows. And then we're going to look at the implication for stability and asset liability management. But in this model, it's also not something where, you know, by tweaking the beta, you could reach more stability. And it comes back to what we talked about with Gregor at the beginning. You know, if your way to keep more deposits is to pay higher beta, you're losing the franchise anyway. So, you know, it's not helping you in a run, or you kind of deter the run. Okay, so now to the more, you know, the run part. So now let's separate the franchise value into 2 parts. A share U is coming from uninsured, and a share 1 minus U is coming from insured. Now, I want to say something which is, you know, just for clarity, we talk about uninsured, insured, as if the insured never run and the uninsured always run, or kind of are very sensitive. Of course, you know, in practice, you have some uninsured depositors that are just completely sleepy, and some insured that are going to be very nervous, even though, you know, they are insured. Just, you know, for clarity, I don't want to say sleepy and flighty, but, you know, it's kind of matching. And we know from other literature that, you know, most of the runs are coming from the uninsured.
Well,
so bank value now.
Olivier, I think in the data, the insured run into banks, not out. So
right.
even for very weak,
insured are transformed into insured to.
Well, yeah, because weak banks are offering high rates on insured generally when they have time.
Yeah, absolutely. Yeah. So here now I'm decomposing the franchise value into 2 parts: DFI, which is coming from the insured, and this is the part that you can rely on. That part is still subject to the rate-driven outflows, but again, I'm abstracting from them here. And DFU is from the uninsured. And crucially, in front of that, you have a lambda factor, which is telling you how many of them remain with you, okay? And lambda is going to be endogenous. The key is that lambda depends on what depositors expect the solvency of the bank to be. So we model that instead of going through the whole micro foundation of depositors, look at their money, optimize, we kind of model that with a flexible reduced form, which is lambda is an increasing function, so cap lambda of V, which is the bank solvency ratio. So think of when you have a higher solvency V, more uninsured depositors are going to stay, and when it falls low enough, some of them are going to leave. Now, what I'm going to show you is with a very simple structure of the lambda, which is this bank function, which is you have a threshold, some insolvency threshold V bar. And it could be positive, maybe if they freak out before the bank is even insolvent. But above that, no problem. If V is high enough, they will stay. If V falls below that, they will leave. And that kind of connects to Gregor's paper that he mentioned. In principle, the shape doesn't have to be bang like this. And you could estimate some sensitivity of uninsured withdrawals to the bank's perceived solvency, for instance, through CDS. Okay, so then you would have a whole shape, which would be an increasing function, but with a slope that's not an infinity here. Okay, now the mechanism, how does it work? It's not that uninsured depositors have to understand the whole model and how franchise value works. Probably they look at some things like stock prices, and you have some bank investors who do understand better, franchise value, and have become nervous about the bank. The stock price falls by like 20–30%. Some depositors start withdrawing, and that's what triggers the feedback loop. Okay, so that's the shape. So now what's an equilibrium? So the shape I gave you was the run incentives. Given solvency, what are how many uninsured depositors leave or stay? Lambda is how many stay. Now, given measure lambda of depositor uninsured that stay with you, the solvency ratio of the bank is going to be a function of that depends on so it's a function of lambda and interest rates. So interest rates affect the value of the bank, even independently of franchise value, just through say asset losses. So that would be captured in the V of 0 or prime term. Okay, but then crucially, the value of the bank when rates are high enough, when the franchise value is positive, is increasing in lambda. That doesn't have to be the case. If you are at the ZLB, you're not making, you actually may be losing money on this. But in the good case, you are making positive DFU or prime, that's the last term. And then the value of the bank increases with lambda. So now you have two increasing functions of lambda. When lambda is higher, V is higher. And so we're going to look for a fixed point in the exposed game between depositors given assets. So for now, I'm fixing the asset structure A, okay, also potentially the asset losses. And an equilibrium is going to be a fixed point where you have some lambda that justifies some value and that justifies the run incentives. Okay.
Olivier, I should have asked the question on the previous slide, but you say you're not doing micro foundation. You have some idea of possible micro foundation?
Yeah, I think for instance that shape you could get it with the diamond deep vig and sequential service constraint. So that shape I think would be consistent with that. It's just that if you had a more general shape, you could do global games and they get some signals and so on. And so that could kind of match the distribution of signals. Yeah.
Yeah, or I put it in like a Leland style model, right? Then you have a solvency constraint literally on, you just have a net worth franchise model, and then equity holders can recapitalize, and then you have that. I mean,
yeah.
So that was sort of, then you don't have to rely on liquidity or sequential service or anything like that, right?
Yeah, I mean, it's related to, like if it's completely free to recapitalize, it's going to affect what's happening. But what I meant, is like in diamond diving. Okay, so given this bang shape, the only equilibria that you can have are 0 or 1. And so, you have conditions to get, either the good equilibrium, the bad equilibrium. I'm not describing the whole structure here. The first line is just saying something, which is the most interesting part, which is, if the value when lambda is 0 falls below V bar, then you get the run equilibrium. Okay. Now you can still have the good equilibrium if V1 is above V bar, but I'm not talking about that part here. And so the run equilibrium is going to appear even though assets are fully liquid again, and there's nothing happening to, in terms of fire sales and so on. It's only because, the complementarities are coming from the deposit side, which is, if all the other uninsured depositors leave, they take away with them the present value of their spreads. And that's what I was counting on to get repaid. And so I freak out and I have to leave now. Now, what's interesting too is that, so obviously the run risk is going to be higher when you have more uninsured deposits. But the more interesting parts are the two last bullet points, which is, first, you're going to have more run risk if you have a lower uninsured deposit beta, which means that uninsured deposits are more profitable. Okay, it sounds a bit counterintuitive because you're making more profits from them, but that's why it's more destructive to lose them. If you have beta equals 1, then they're not bringing any value to the bank anyway. And so whether they leave or stay is irrelevant, and it's not going to create a run. And so this is more like in the cross-section, you have banks with lower and higher beta. And then in the time series, earning all banks at the same time, when you have higher rates, it's making all the franchise values higher, making all the uninsured deposits more profitable, and then the run's more destructive, and therefore run risk is going to increase. So on the graph,
so I have a question, Olivier.
Yes.
So could you go back to the previous slide? Yeah. So for banks with lower beta, these are the banks with higher market power, so more sticky deposit rate. And these are the,
it's a bit tricky.
these are the banks where the sort of the quantity is gonna adjust more, right?
No,
so
that's a good point. So that relates to the part that I'm abstracting from, which is this rate-driven elastic.
Yeah, exactly. So could you comment on that, how that is going to influence this result if we take this rate-driven deposit flow into account?
So we do that in the paper. So what's happening is that you're absolutely right that if you look at the deposit channel estimates, banks with lower beta see stronger outflows. And the idea is that, well, maybe it's all optimal because the bank is internalizing this, but earning more on the inframarginal. Now, the extent by which in the cross section of banks outflows are stronger for lower beta, it doesn't revert the thing, and so overall, the effective duration of these liabilities for these high market power banks, low beta, is still longer. So it just dampens a little bit in that direction, and it kind of makes sense because they could do what the other banks are doing, so if you write the optimization problem. So here, absolutely, I don't have these formulas for W prime, but that's a good point. So the rate-driven outflows would be stronger, but in terms of franchise value, they would still gain more than the other banks. Okay? Okay, so on the graph, what's the equilibrium? Well, you have the first shape, which is the bang, the run incentives. And then now this blue line I added tells you, the other condition, which is the bank value as a function of the mass of uninsured depositors remaining. And so the top dot here is V1 of R. So you start from lower rates, R, the baseline rate. And at this rate, V1 is here. And you see that V0 is to the left. So the horizontal distance is the franchise value that you're losing if everybody leaves, if all the uninsured go away. But that's not too big because you start from low interest rates. So in fact, if you start from an interest rate such that franchise value is 0, V0 would be exactly, the same as V1. The line would be vertical. Here I'm starting from a rate where you are making some profits, but not too much. So you move to the left, but not by enough for run to become an equilibrium, because it's still to the right of the run threshold V bar. Now, suppose, you do everything right in the sense that you look at this equilibrium and you choose your asset structure to hedge perfectly. And not only you're matching duration, you're even matching convexity and everything, and exposure to slope. So you're doing everything so that after the shock, interest rates went up, but the value of the bank in the good equilibrium is exactly the same. Okay, so I just want to say it's very strong. It means that you're matching everything. You're matching the effective, not only duration, but also convexity of the franchise and so on. So that means that, in the good equilibrium, nothing changed. But in the background, now the franchise value has increased a lot. And so the horizontal distance that you're losing if you have a run is much bigger. And it can go, in fact, all the way below the threshold so that run becomes an equilibrium. So now you have two intersections, two fixed points, two equilibria. Okay? And so now if you change the beta, for instance, you have different shapes too. So what's now going, this is exposed. So this is given some asset structure. Now, why would the banks do that? Why would they be in the situation where, what should the banks do given this problem? Now you have two risks. The problem is in this model, you have two risks. One is pure interest rate risk, unrelated to runs. That's happening even if you only have insured deposits. And one is run and liquidity risk, but it is related to interest rates. So it's not completely independent. And so thinking of writing the value of the bank, you have V1, which is V0 plus this franchise from an insured. And so it's impossible to maintain V1 and V0 constant. You can't hedge both. And so just, illustrating what I showed graphically, suppose the bank perfectly hedges interest rate risk in the good equilibrium, then there is a threshold or bar above which, if interest rates go high enough, go above our bar, you're going to have a run. Okay. And so the formula for our bar is quite intuitive. It's kind of follows what I said about, the comparative statistics of runs. And basically, if your beta goes to 1, you don't have a run equilibrium. So the dilemma is really caused, the wedge in terms of, what you should do with your assets is really caused by this low beta uninsured, not, competitive wholesale funding. Maybe in 2008, there was a lot of worry more about, wholesale funding runs, but here they're not creating any problem because, wholesale funding wouldn't give you any profits in the first place. Okay. So we really have in mind, retail uninsured and corporate checking accounts. Now,
so just, small observation here, which is, again, in the data, if you were to look at the regional banks, the banks with more uninsured deposits had greater deposit betas. So I don't really know. I don't know if you can speak to that observation.
Right. So here it's the beta U. It's true that uninsured deposits in general have higher beta than insured. And the wedge is like 0.2, 0.3. So it's true, yeah. But now what matters for the run risk is only the beta of an uninsured. Now that's not something you can see readily because, it's not like the interest income on an insured is reported.
You can. But...
You can try to estimate this, and you can kind of get these betas, some approximation. But so here it's really, there's some beta insured somewhere, but it doesn't appear in this formula. It's irrelevant. It's going to appear here, which is what is the strategy that you should take to hedge your interest rate risk. It's very transparent. What you should do, if your goal is to stabilize the value of the bank, and coming back to Gregor's point, where we're not showing why you would do that, but you can think of an extended model where there are reasons to do that. Suppose they want to do that, yeah.
Well, yeah, sort of like if I wrote down the standard model of banks, I would feel like, if anything, you would want to not hedge. In some ways, it's puzzling that they're hedging the good state at all, since they're levered 9-to-1 with government backing on 45%. So and I can totally see that consumer surplus is huge. So there is you can squeeze the deposit franchise, but outside of the bad state in which a deposit franchise disappears, I guess I am sort of struggling with why you'd want to hedge. Why would you want to insure against the volatility? In some ways, sort of. I guess why are bank equity holders really bad at carrying this kind of risk? I guess is another way to ask in the economy. Why are they not good at risk sharing? Why does somebody else have to do it?
No, that's a good point. I think we're lacking the relevant frictions to talk about that. So it's more like speculation. But it's more like you have some exposure, and therefore maybe you don't have to do anything, but maybe you want to hedge part of it. And now we're going to the extreme where you hedge the whole thing. But what we're saying conceptually is a bit more general. You don't have to hedge.
I agree.
You could allow some sensitivity, but you would do something in that direction. You would not completely discard this. So here what I'm showing is the extreme case where they go all the way. In fact, so as you say, it turns out if you match the numbers, that it gives you something very close to the actual durations. So it's not clear why which kind of frictions lead them to do this, but that's what they do to first order. So what would banks do if they kind of try to hedge this? Well, they would invest in assets that offset the full negative duration of the deposit franchise. And so the asset must have duration coming from two parts. The first term, 1 minus u, is the to offset the negative duration of the insured franchise. And the second term is to offset the negative duration of the uninsured franchise. Okay, so very simple. It's just from the formulas that I showed you before on the durations. Now, hedging run risk, meaning investing in assets that prevent the run from happening, would require you to kind of ignore any negative duration coming from the uninsured. Basically, you treat them, you just hold cash against the uninsured, and that would prevent the run from happening. So you would have potentially a much shorter asset duration if you have a lot of uninsured with low beta. If U is 0, they're both the same. Or if beta U is 1 and you don't have the second term, but otherwise there is a wedge. So that's what we mean by dilemma. But just to clarify, as Gregor says, the first line is more, suppose banks wanted to do this, maybe they have a more complicated objective, so it's not going to be exactly this duration, but it is going to be longer than what's required to hedge the run risk. Okay, so why are they exposed? What's the problem from holding short duration assets? Well, you have this balance sheet, and when interest rates fall, you're losing all this franchise value from insured, and so your value is falling. So we talked a lot about this, the potential cost and so on. Now, just to illustrate a bit, because I mentioned that to Gregor, what's the problem when interest rates fall and you're unhedged to interest rate risk, meaning your assets are too short? Then, instead of having the top point that stays fixed, it kind of shifts, it rotates to the left. And now you can be in the situation, but it's not like the run that would happen at higher rates, because that's a situation where the deposit franchise value is actually negative. So, you're in trouble, you go towards V bar, but it's not a full-blown run, because as some depositors leave, it's kind of stabilizing the bank. In fact, it's kind of I think it's a simple model, so it's a bit extreme the way we model cost and so on. But the idea is that because they are unprofitable, if they leave, it's not a big deal. Here it even helps. And so the bank has a problem, but it's not a problem of a run. It's not a self-fulfilling thing. Okay. Now briefly, on credit risk. For now, I only consider interest rate shocks, but it interacts, which is, when you have higher rates, you have a higher franchise value. And so you're going to be more exposed to other shocks, other unhedged shocks like credit losses, just because, they could trigger a run on the franchise as well. Okay, so suppose here I have a shock S to S prime. It's a fall. It's a parallel shift now. It's not a rotation because it affects your value, regardless of the number of depositors that are left with you. But, now if interest rates are high enough and you have the shock, then you may create the bad equilibrium, the red dot. Whereas, if these lines were vertical, so no franchise value, then you would still be in the good equilibrium on top. Okay, you would be exposed to the shock, but it wouldn't have this double whammy effect. Okay, I'm gonna skip this, which is the implications for monetary policy, just to talk about potential solutions. So first of all, given some equity and so on, it is a dilemma. So you're not gonna have a perfect solution. So the way to improve on that, you need more equity. But the question is, what do you do with your equity? So to hedge against runs, now you have these two problems. You want to hedge against runs when rates go up, interest rate risk when rates go down. So margin compression risk, that's how they call it, which is, they're losing this franchise value when rates go down. And so you want some very asymmetric profile for your durations. And the way to implement this, so there are many ways to do this. Conceptually, you want puttable long-term bonds, which is to say a combination of the standard long-term assets that you would hold if you didn't have run risk. And so that's the first part. Okay, you don't need to look at the detailed formula, but basically you have one part, which is you need to hold long-term assets to hedge against rates falling. And you need some extra term, which are call options on interest rates, which are kind of options that trigger a payoff that become, that are in the money when rates cross a threshold, which is exactly our bar, this run threshold I showed before, which is depends on your beta, depends on your uninsured ratio. So each bank is going to have to hold a different amount of these options. But if they have this, then it means that as soon as interest rates cross the threshold, you have some automatic injection of capital into the bank that protects it and kind of deters the run incentives. Okay, so now banks already hold.
Yeah, sorry.
It sounds like
One quick question: Would your and I don't disagree with anything you said, but would your thing be replicated by a dividend policy? Like, because a lot of banks still, rates have been going up, but they kept on paying dividends, so that they could have just slowed down their dividend payments or retained some cash in the high interest rate environment, but they chose not to. So how do you think about that?
No, that's a good point. Yeah. So there are many ways to replicate. Yeah, like in continuous time, you don't have these options. You could replicate unless you have jumps and so on. And then what we're saying is that you need more capital as rates go up. And for sure, one way to do it is to pay to kind of stop paying dividends. So the way we view it is that banks would do this by themselves if they didn't have any cost of issuing equity. So if you have some cost of issuing equity, which is like the mirror image of wanting to pay dividends, then you need it's exactly the same problem as not holding enough capital, and you need regulators to ask them to do this. So banks already these options may sound super exotic, but banks actually already hold this option to hedge negative convexity coming from the mortgage-backed securities prepayment risk, and we're saying you need more depending on your uninsured ratio. You also need some amount to hedge the run risk, but it requires capital. Our conceptual point is more like, well, how do you prevent the run? You need some more capital, but the capital should not be invested in cash but in these options, because cash would have a duration that's still too short. Yeah,
but in your model, banks want to do this, correct? You don't need the government
model
to do this.
Without friction to issuing equity, they would do it. Because from a bank's perspective, it's like you have these crazy uninsured depositors that would destroy your value. Right. So if you can do something from to prevent this, you would want to do it. Yeah.
But so bank equity holders capture these externalities of runs, so they might as well just do it, right?
Yeah, because there's
no need for policy.
The franchise value goes to them.
Right. So there's no need for policy here.
Sorry?
There is no need for regulation here, right?
Yeah. So here I'm not talking about policy here. Here it's like what the bank should do. But if there are some equity issuance cost or something, some other friction or some reshifting incentives, then that's there's a role for policy. But for now, in principle, without other frictions, the bank should do it. So that's how it would look like, as a function of interest rates. On the left-hand side, you have the regular long-term asset with some duration. So if you calibrate, it's around 4 years, okay? So it means that, it decreases quite a lot when interest rates rise. But, you have this vertical line, which is the strike for these options, which is, beyond that. And so here it's around 3.5%. You need the options to kick in on the right-hand side and inject equity. So I'm going to skip this. Now, there are other implementations by put call parity, but one thing, and maybe it gets even closer to this policy question, which is one way to do it is exposed. You don't have to, in this model without friction, this could happen exposed. Now, in practice, you feel that, well, if you ask banks or banks try to recapitalize when it's too late, they're going to trigger a run. And that's exactly what happened with SVB. So you need a rule that's, really dependent on interest rates and kind of, affect, so no stigma. So it's not like you're going to the market to issue equity because you're in trouble. But, there is an ex-post implementation, which is just replicating what the options do, which is as interest rates go up, banks need to raise capital and to exactly, offset the gain in the uninsured franchise. And on the graph, it's very intuitive, think of low interest rates as, what I want is to prevent the bad equilibrium, the bad fixed point from appearing. So at low rates, I need some capital, which is this buffer here, which is kind of against the uninsured franchise value at low rates. And when rates go up, I need to issue this extra amount of capital so that the bottom point always remains, just to the right of V bar. But that's what the options would do too. It's just the options, you do it ex ante at a time when rates are low. And so it's not like you're going to trigger a panic. Again, this is outside the model. So the last point, it is a model of self-fulfilling runs. And as in many of these models, there is a policy, which is, lender of last resort, which would, solve the problem. There are many policies, here, you could insure everything, for instance, and then it would solve the problem. So in each of these cases, it's probably because we're not, incorporating other frictions, so it all looks, similar. But just to understand the logic, how would it work here? The lender of last resort, suppose the bank has some uninsured deposit run of size 1 minus lambda, and the bank can borrow from the Fed at par some amount, so meaning at par against the old value of assets, A of R, then the only equilibrium is the good equilibrium without runs. And what's the intuition? Well, you start from low rates. Suppose you start from a situation with no franchise value, so the balance sheet effectively just A and D. Then you go to higher rates. So now assets have fallen. You have this rise in the franchise value that may offset it, but it's fragile. So that's why it's like in dots here. And what the BTFP policy here, the lender of last resort that resembles BTFP, is that you can pledge the increase in franchise value to get some junior debt, and that's going to kill the run. Okay. And why does it match? Why does it look like borrowing at par? Because then in the good equilibrium, the total value, you would be perfectly hedged to the change in asset values. That's the asset value exposure, the duration you would choose, you offset the franchise. And so the total size would actually be A of R, which is at the old interest rate. So, yeah.
Olivier, can you explain this a little bit? So what rate are you paying to the Fed?
Here you can pay a competitive rate, so R prime, you pay the new rate, but the question is how much.
No, but why? Wait, sorry. R prime is the Fed funds rate? Sorry, I lost a bit of it.
R prime. So here it's sort of like flat yield curve and so on. So okay. Sometimes R prime is more like when you do the valuation, it's more like the long-term rate. But here it's the same. But it is the Fed funds rate, say, or the market rate.
Okay.
Yeah. So you're paying the same amount. It's not like the Fed is making a loan that's very cheap in terms of rates, but it's allowing you to basically pledge the increase in franchise value as collateral. And then the debt that you get is junior, and so it's not.
And is it junior to depositors or senior to the?
It's more like a maturity thing, so it's not going to run. So it's not runnable, and so that ensures that you do have the franchise value to pay the other ones, and therefore they don't run. So maybe I conclude and we talk. I don't know how. Where's Brianna? Okay, so let me conclude here just to remind the main points. When you have low beta uninsured deposits, for instance, retail, corporate checking, that creates a runnable asset, which is the uninsured deposit franchise. Okay, so one part, the insured franchise is going to be there, but one part, if you have a lot of uninsured, more of your value is going to come from this. Because that franchise value is naturally exposed to interest rates, your liquidity risk increases with rates. And so how can you prevent this? Or what should you do ex ante? Well, it's not clear because banks need both assets with long duration to hedge interest rate risk against falling interest rates hurting their franchise. But they also need short duration to avoid run risk against increasing rates. And we propose some solutions like options or rate cyclical capital. So the idea is that you have something varying with interest rates, this run risk. And so you need capital to be injected as rates go up. Thank you. Thanks a lot for the questions.
Great. So now we have a Q&A. As a panelist, you are just welcome to keep chatting and then ask questions. And as attendee, if you want to ask questions, you can just use the raise your hand features. Okay.
I felt like I asked too many questions, so I was going to shut up. But then if nobody's asking, can you explain this Fed thing? Just if the Fed, perfect. Like if I replace all the deposits that I was paying 3% on with the Fed funds that I'm paying 5% on.
Oh, you're not replacing them. So they're still here. You're adding some debt on top of them. But because you add this, they're not going to run here.
Okay.
Is it as if you're changing a lambda, right, to some extent? So you're making lambda less important.
But the resulting equilibrium lambda, is going to be 1, but in a way that
they're like insured deposits. Basically, they don't run, in a sense.
Yeah. Well, not exactly, because if you add insured, it's going to give you franchise value.
Okay.
So that's back to the question, which is the Fed is not giving you franchise value. It's allowing you to preserve the private sector franchise value.
But conditional on a run, I guess. So now imagine you did this and conditional on a run. Why does this Just walk me through how this works. So there is no more franchise value to be had. Is it because B is subordinate to depositors?
You can use the B to pay them.
So it's subordinate. So you've entered subordinate debt to depositors.
Well, I view it kind of because it's static, but it's more a maturity thing in practice, I think.
Okay,
yeah.
so you've added subordinate. Okay, I see. So in some ways, you have government adds equity, but doesn't get paid equity prices.
Well, the government is getting a prime on that debt, so it's not like they're giving it for free.
No, but they're giving it as though it's risk free, right?
Because in equilibrium it is risk free, so that's because it's self-fulfilling.
Right.
Like
no,
other shops and so on. Yeah,
right, but in your model, equity is risk free too. So equity should be totally happy to get paid risk free on bank debt too, and that's a bit odd.
Then you come back to these unmodeled frictions of
No, but that's what I mean, right? If being like right next to equity makes you risk free, but being equity makes you risky, and you should get market comp, it's a little bit odd that the government debt is completely risk free, and it smells like a subsidy to me. And I can see how in the model it's exactly risk free
because off equilibrium subsidy, but the in equilibrium not a subsidy.
Exactly.
Yeah,
but it seems like then equity should also be risk free in your model, pretty much here. I have a very hard time seeing how like.
No, here yeah, I agree. You could say, well, some equity holders do this, the B,
right.
And without further frictions, it should be equivalent to the government. But they should have some kind of commitment to do it, so that the run doesn't appear.
Right. So yeah. Okay. Cool. Now I get it.
Thanks. Yeah.
I think this was in the background. Oh, sorry. Go ahead, Roberto.
Oh, sorry. Yeah, I have a question about a comment more about the capital requirements. So if I understand correctly, one of the solution you propose is to increase capital requirements when rates go up. Is that right?
Yeah.
Yeah. So I think that what's happening in practice is exactly the opposite.
Yeah.
Because capital requirements are computed on kind of a mix of market and non-market value, historical value of the assets, like the ones, SVB is famous for having all these assets at the cost. So I like a regulatory capital of like 10%, but market capital or 0, right? Which means that effectively the capital requirements now are actually go the opposite direction. Like if you think about the market value of capital. So like what you're saying is like, the way the system is designed now is like it actually moves the black lines like in the opposite direction, like in the wrong direction, right?
Yeah,
doesn't even keep it where it is. It moves it in the wrong direction.
Again, yeah, you're saying capital requirements don't mark to market like to the assets.
Yeah,
we're saying here, thanks to the franchise, assets would not be a problem, so you mark to market to the franchise value. But it's kind of very similar in spirit to what you're saying.
No. What I'm saying is that what's the way it's happening now is that
I agree.
Capital requirements are kind of going down when interest rates go up, right? Because banks are allowed to operate with like, that's kind of the point you had at the beginning, Gregor's point. Like, banks are allowed to operate with like because they have all these losses that are not included in their balance sheet because their balance sheet are not marked to market. So they're allowed to operate with a very, very tiny capital requirements now that the interest rates are high. What you're saying is,
Roberto, but wait a minute. In the good equilibrium, that would be okay. It would be like the hold to maturity. You don't mark to market the assets nor the liabilities. And in the good equilibrium, if they follow the strategy I described, it would be totally hedged, and so it would be okay. So here in this model, it kind of simplifies a lot. But the only problem of not doing that is from the runs potentially appearing. And so then you kind of increase the capital to prevent this. But if you didn't have runs, for instance, if they were, it's hard to say, but say the beta were 1 or something. So there's no franchise value from the uninsured, then not marking to market to the assets would not be a problem here.
If the uninsured deposits are completely sleepy, it's not an issue because they are not. Then
but here they become they're not sleepy, but it becomes because of this run risk, but not directly pure interest rate risk that you're mentioning, I think.
Okay.
But thanks. Yeah, that's a very good point. Yeah. Hey, Jin, how are you?
Hi, I have a question. My connection is bad, so
Okay.
I'll close the video for a bit. So I have a question along the line of individual banks versus the banking sector as an aggregate. It is no difference in your model, but I wonder if you include some payment utilities so that this uninsured depositors needs to fulfill their payment services somewhere, say from SVB to Chase. Would you have a prediction that banks like Chase will never have this bad equilibrium? And also the last proposition, once you allowed interbank borrowing, SVB borrowing from Chase, you will have you will kill this bad equilibrium for the banking sector as a whole.
So two things, yeah. No, it's true. We don't model like multiple banks here. So I think there's something very interesting. We started doing a bit with multiple banks, but it's not here. Which is, how much of the franchise value is conserved, and it goes from one bank to the other, which is not exactly your point here. But coming back to your second question, yeah, this point could even be implemented by some private insurance market. But it's kind of, very strong. But, suppose banks write, contracts where, now it's a bank that lends to the other, basically takes this junior debt in the other bank. In case a run happens, it would also build the equilibrium here. Now, it's kind of, they have to follow through on their commitment and so on. So that's why maybe there's some asymmetry between the government and private sector cross insurance. But it's not in the model. So I agree with you that, some this could be in principle replicated by some private contracts, and they would be risk-free in equilibrium, exactly for in the discussion I had with Gregor. Now on your first point, yeah, I didn't totally understand the payment thing, but basically you're saying, is it because of a reallocation of franchise value, or is something else?
It's something like micro foundation for the franchise value. So even if the banks have just slightly different betas, you will have a case that the uninsured depositors will go to Chase. So the banking sector as a whole, they have sleepy depositors.
Oh,
That's
yeah.
what I
So
mean.
this I agree. Yeah. Well, in fact, one point that, when we started doing the multiple banks case is to say who should provide these options, and there is a simple framework where, the options should be provided by JP Morgan, because they're going to get the flight to quality and the rise in franchise value. So they're gain in this event. And so they're the ones who should, sell the options ex ante. Thanks. Yeah.
So, Olivier, can you it's the flat term structure here seems to be important.
Oh, no, in the end, it's not.
No, but well, if you go to your last slide around the conclude.
Here?
I mean, I don't think it's important for like the mechanism or anything. I just kind of wonder to what extent like your idea that the risk management dilemma, right? Are there certain shapes of the yield curve that basically make the dilemma worse or better in some sense? Because I mean, as you change your duration, you're also changing effectively the spread you earn over deposits, right? If the term structure is not flat. And so I could imagine like, if just say there was like a strongly inverted yield curve. I don't know if I'm going to get this right, but like basically you could earn a big spread and eliminate the run risk.
Yeah,
you know what I mean?
So I haven't thought in terms of the liquidity risk, so that's a good question. But in terms of pure interest rate risk, if you had like term premium and so on, not much would change. So I think you're talking about the runs, and I haven't thought about this.
Because the franchise value depends on the spread, and I'm just saying the spread depends on.
Yeah, right? But here it was all okay. So the way in the more general model, if you want to write the franchise value, let's see here, it would have its own exposure to the whole term structure, basically, because you would compute, each depositor is paying the short-term spread in this period for some lifetime. So for that depositor, what matters is some kind of long-term rate for given the delta. But the franchise value basically itself has some, exposure to the whole term structure. And so what you need to do is match not only the duration, but also, say the convexity and the slope exposure if you want to hedge interest rate risk. But you can do it because the franchise value is like some fixed income portfolio that you can replicate with bonds. So now that's for the pure interest rate risk case. So this is just to say that you could hedge interest rate risk even though you have any kind of term structure affecting the franchise value. Now for the runs, yeah, I haven't thought about that. Like would the run incentives be based on the? So that's a good point. Yeah, I need to think more about this one. Does it make sense? So because I only talk about durations, but
no, but that's exactly my point. Like,
yeah,
right. That's all.
Thanks. Yeah.
So what returning to the question that Gregor asked before about the, would banks do this hedging by themselves? I wasn't totally sure I understood the answer. Is like, you don't need any policy intervention. Like, I mean, it depends on the cost of the hedging and the benefit. I mean, if the run probability is pretty low and the hedging is expensive.
Because every equity holders here internalize everything, right? There's no model. The only externalities are between uninsured depositors, and the equity holders can internalize all of that. That's why in principle, I don't think you need any external forces, because equity holders are super happy to like put any hedge in place that prevents it with the franchise value. Because given that the model has no moral hazard.
They're capturing so the value that's destroyed is going to them. Yeah. And so yeah, they have a huge willingness to pay for this.
Because the run doesn't destroy anything about like, the FDIC doesn't have to step in this case.
Yeah, and think of it, there's no consumer. I mean, another way to think about this is suppose there's consumer surplus. So what happens from the beta perspective is beta really means that there's market power, and market power comes from consumer surplus. Then there is spillovers to the consumers. Maybe there is space for policy there, right? Because even, or you can put it in a market equilibrium where there's spillovers between banks.
I think then you have to think more about what Jean said, which is, are they losing their surplus if they go to another bank, the switching cost.
But that's why if you look like in my AR paper, I do the industry equilibrium. And what happens in those equilibria is we don't have the interest rate stuff, but we have the the run with liquid asset stuff. It is almost impossible for all banks to go down. In fact, we find no equilibria like that, because depositors, like Jin said, go somewhere. Like they want to bank. And because they want to bank, there's banking surplus. And yeah, some money can leave the banking system, but at the end of the day, there's always going to be franchise value somewhere because consumers are willing to pay for it.
But so one implicit assumption, there's no, like, for instance, because in practice, a lot of times when you have this, like, SVB, there was a run, but then there was exposed. It's like, okay, let's bail out the uninsured deposits, right? So when you add that, then they might not do it.
Of course.
Yeah. So here, it's all about the unmodeled cost, like more hazard, equity issuance cost. So I was just saying, if you don't have other frictions, they should do it.
That's I understand the context. The model is, I like the model, very simple.
But there are natural forces towards, having a role for the government, I think. Yeah.
Thank you.
Thanks.
But with that overhang, they would already not do it, right? Like by hedging themselves, maybe they lose the option value of going bankrupt.
Yeah.
And
And they also have insured deposits, so they have this put option there. Yeah.
Cool. Okay, this was awesome. I apologize, I gotta run, but this was
Thanks
great.
a lot,
Thank you for
Gregor.
having me.
Thank you. We will also stop the recording here, but I can keep the room open in case you have other questions.
Thanks, everyone.
Thanks.